Hey everyone, welcome to Lesson 6, where we're going to be covering lending and interest. We've already been introduced to the concept of lending, but just by a different name. We've called it credit. They're really the same thing, but interest is going to be a new concept that we'll talk more about today. So previously, we introduced some of the entities in our economy, individuals, businesses, and governments, and they're engaging in trades amongst themselves. And a reminder, they are exchanging one good for any other agreed upon good. The most common good that they would exchange would be money. And so far, everyone has been trading things that are instantly settled. Now, what does that mean? That means when one party gives a good to another party, the other party exchanges a good at the same time to settle it in return. And that is the end of the transaction. And they each go on their way. So that's a normal trade, and lending is just a specific kind of trade. It's a trade between two goods, but it's one good for another good later. So this is going to be key and important, especially as we start talking more and more about finance. We have the starting to build up the economic underpinnings, but especially with finance, we're going to start exploring things that are not just in the present, but things that may happen in the future and things that may take time. So this later is really key to lending. And we have specific names and terminology for people who engage in this sort of transaction. The person who is promising the goods later is called the borrower. And the person or entity giving the good for use now is called the lender. Now, this doesn't have to necessarily be money, but as with most exchanges in a modern economy, it's probably going to involve money. And it can even be money for money, which is quite common, where a lender has extra numbers in their bank account, has extra money, would give some of that to the borrower, and the borrower could agree to give more money back to the lender at a later time. So why hasn't this been occurring already? Well, if we consider the perspective of the lender, they have no reason to give any good up to another party or another borrower for free. So later entails risk and time. It entails time because the lender could have enjoyed that good himself. And so he wants to get paid if he's going to lend that good out to someone else. And not only is there the time that he's worried about, there's also risk. Because if I give a good, if I lend out my hard-earned money to someone else, they might not be trustworthy. There's a slight chance, perhaps, that they might not pay me back. And so most of these trades, these lending transactions, would not occur if there wasn't something called interest. And interest is just a compensation for the risk and time that I just explained. So anyone can be a lender, anyone can be a borrower, as long as the two agree to make an exchange, just like in normal trade, we can have a lending transaction or a loan, or there are many other names. If we think of Alice, for example, she has some money saved up from her production, and she wants to make some extra money with that. But she wants to be paid because she's not going to consume it, and she's not going to be able to enjoy the money or goods in the meantime. And in case she's not going to be paid back, perhaps she lends it to Bob and Ben's Bakery. That's a business. They're starting up. They need to buy an oven. And so they're going to take Alice's money, buy that oven, be really productive, create a lot more bread, and they're okay with paying back Alice later with all the extra money they earned. And typically, when we talk about interest, it's quoted in annual terms, based as a percentage on the amount that's borrowed. So just as an example, if Alice had lent Bob and Ben's bakery $100, and Bob and Ben had agreed to pay back 2% per year on the $100, then they'd be paid 102. Right, they pay the 100 back eventually, and then 2%, but it's all negotiated between the parties. Right, this would be a loan for 1 year. So that's it for today, and I'll see you in the next lesson.